A venture capital trust is an investment company listed on the main UK stock exchange, which pools investors' money with that of many other investors to access the underlying investment of UK small companies. The big advantage of a VCT is it gives the investor a very significant tax break in return for taking a degree of risk by helping support those smaller companies. As a VCT, we have to meet very stringent qualification criteria on a venture capital trust and the underlying investments that we make. So the businesses that we invest in can have no more than 250 full-time employees and no more than £15 million of gross assets at the point at which we make the investment. But that still means they can be relatively sizable businesses. Venture capital trust gives you really exciting tax breaks, and that's one of the key things that makes them attractive as an investment. As an individual investor UK taxpayer, you can actually get back 30% tax relief on the first £200,000 that you invest every tax year. So for those earning enough, you can actually save yourself up to £60,000 of tax per year. And at the bottom end, you can invest from up to £3,000 and still recover £900 of your tax bill. In return for those tax breaks, you do have to invest for at least 5 years. And that's a really important point to make, because if at any point you chose to exit the VCT prior to finishing those 5 years, you would have to pay the tax back that had been given to you by HMRC. In addition to the income tax relief, you'd also get other tax breaks. Any capital growth within the investment is completely free of tax. Plus, any income that's paid out during the time you hold it will also be completely free. And that's one of the key things that makes it attractive for so many different types of investor. Importantly, although you're limited on the 30% tax relief, you can't have back more tax than you've paid in the current tax year. But that doesn't have to just be on salary or self-employed income. It can be on other tax you've paid or any other income tax you've paid during that year. So for example, it might be from rental of properties, or it could be from other investment income, such as investments held on deposit, where you're paying tax on the interest you receive. A venture capital trust has the ability to distribute the profits it makes through a tax-free dividend income stream. And that's one of the key things that makes it so attractive to so many different types of people. That tax-free income can be then used to perhaps supplement a pension, for example, or it may just be used as extra spending money for a household. A VCT is a really powerful planning tool, and it allows advisors and clients to take advantage, in particular, of the tax-free income stream. So we're seeing an increasing market for VCTs to be used alongside the pension planning that investors would normally do, because with a pension, any money you put in it is partly locked away, and the income received will be taxable. A VCT can be used to really complement that by providing a tax-free income stream, which can then supplement the pension, giving individuals the level of income and lifestyle that they would then want for their retirement. At a simpler level, there are a lot of people who resent paying as much income tax as they do, and a VCT is a very, very simple way of reducing their income tax bill and allowing them to help the UK economy grow by investment in UK small companies.